How much cash should I keep in my investment portfolio as a retiree? Are you wondering how much cash to keep in your investment portfolio as a retiree? This is a common question, and the answer can vary based on several important factors. Let's break it down together. Generally, retirees should aim to keep between 2% and 10% of their investment portfolio in cash. However, the exact amount really depends on your personal situation. Factors like your age, sources of income, risk tolerance, and living expenses all play a role in determining the right cash balance for you. One common guideline is to have 1 to 2 years' worth of living expenses in cash as you approach retirement. This cash reserve acts as a safety net, allowing you to cover essential expenses without needing to sell investments during market downturns. For instance, if you plan to spend $50,000 annually, having $50,000 to $100,000 in cash can provide stability. Beyond this immediate cash reserve, many retirees also create a short-term reserve. This reserve can be equivalent to 2 for years of living expenses, and it is often invested in high-quality, liquid fixed-income assets like short-term bonds or certificates of deposit. These investments can generate some income while still being accessible when needed. Your risk tolerance is another key factor in deciding how much cash to hold. If you prefer a conservative approach, you might keep a higher cash allocation, perhaps 10% or more. On the other hand, if you are more aggressive in your investment strategy, you might find that 3% to 5% in cash is sufficient, allowing you to invest more in stocks and bonds for growth. As you age, your portfolio allocation typically shifts toward more conservative investments, which often means increasing your cash holdings. For example, retirees in their 60s might keep around 5% in cash, while those in their 70s may increase that to about 10%. By the time you reach 80 years old, it is not uncommon to see cash holdings of up to 30%. This gradual increase helps manage income needs and reduces risk as you get older. In practical terms, it is wise to hold cash in a safe, liquid account like an interest-bearing savings account or a money market fund. This ensures you can access your funds quickly without facing market risks. Meanwhile, your short-term reserve in bonds or certificates of deposit can provide some income while maintaining liquidity. To sum it up, retirees should keep enough cash to cover at least 1 to 2 years of living expenses for financial stability. Additional short-term reserves in liquid fixed-income investments can extend this cushion even further. The right cash allocation will depend on your unique circumstances, including age, risk tolerance, and other income sources.